Um, Hello everyone. This is the opening of our presentations. This presentation will provide you with a solid foundations for understanding this important topic. My team member have 4 persons, and we will go deeply to the definitions of financial statement. Thêm một slide nữa. Một slide nữa nha. Okay, thank you. In this slide, we will get into the definitions of financial statements and what is the importance of it. Financial statements are written records that convey the business activities and the financial performance of a company. Financial statements are often audited by the government agencies, accountants, firms, etc. to ensure the accuracy for tax financing and investing purposes. What is the main purpose and importance of financial statements? First, is that is providing information, measuring performance, and supporting decisions making. Financial statements provide information about company financial health and position, including revenues, expenses, assets, liabilities, and equity. This information is important for investors, creditors, and other stakeholders to make informed decisions about the company. And the second is assess the financial health. It allows investor and creditor to assess a company financial health and stability, including its ability to generate profits, manage debt, and maintain quality. The third is facilitate comparisons. It allows investor and creditor to compare the financial performance and the positions of the company to another, as well as trends within the same company over time. Finally, meeting legal and regulatory requirements. Companies are required by law to prepare and file financial statements, which are subject to audit by external auditor to ensure accuracy and compliance with accounting standards and regulations. We will move on to the questions how the investor might use financial statement to forecast the company future performance. The first, the investor wants to forecast the company future performance to determine whether it's a good investment opportunity or not. The investors start by analyzing the company financial statements, including its income statements and balance sheets. They look at the key financial ratio, such as the company revenue growth rate, the profit margins, and returns on equity, to evaluate the company financial health and performance over time. The third is identify risks. Investors analyze company financial statements to identify potential risks, such as high level of debt, declining revenues, or low profitability. They use this information to make informed decisions about whether to invest in a company or not. Finally, investors use financial statements to forecast company future and positions. They look at financial projections and estimates to evaluate the company growth potential and to identify potential risks and opportunity. How many main types of financial statement? We have these 3 main types. The first is balance sheet. Go to next slide, please. Thank you. We have 3 main types. Yes, more. Một slide nữa đi. Okay, thank you. There are 3 main types of financial statements. The first is the balance sheet. Secondly, the income statement, and finally, the cash flow statement. My member in my team will soon let you know deeply about each topic. This is the end of my presentation. Thank you for listening.
nào bắn thì tàu cái que này cũng hay luôn á.
Hello everyone. Here I will give a presentation on income statement. What's a income statement? Income statement is a financial statement prepared periodically for the purpose of compiling accounting data, reflecting the result of products and business activity of each enterprise through the indicator of revenues, costs, and profits. There are three types of income statement. Annual business result report, mid-year full mid-year income statement and mid-year income statement. The income statement includes revenues, expenses, and profits. Revenue is proceeds from the consumption of goods, services, and products. Expenditure is money spent to serve the purchase of goods and services, and for the uh, management and consumption of such goods and services. And corporate income tax payable to the state. Profits is the amount that remains after taxing revenues minus expenses. Principle of pre, pre preparing income statement. The, the preparation and presentation of the income statement must comply with the provision of accounting standard. Um, situation in essential information must explain to help reader understand the true financial situation of the business. The income statement must reflect the true economic nature of the transaction and event, rather than a legal form of such transaction and event. Item of revenues, income, and expenses must be presented in accordance with the principle of appropriateness and ensure the principle of caution. Requirement for information presented on the income statement. The incomes the information presented on the business result report must honestly and reasonably reflect the business result of the enterprise. Financial information must be appropriate to help users of the income statement predict, analyze, and make economic decisions. Financial information must be fully disclosed in a material respect, and information must be timely, verifiable, and understandable. Uh, Financial information must be presented consistently and be comparable between accounting periods and comparable between business. The income statement have reader of financial information, understand the business, how much the business consumption of products, goods, and services in a year, and at the same time compare it with the figure of the same period last year. In advance, from which to understand whether the business is increasing its business or not. We will know other income, other expenses. The business account for a large proportion on the income statement or not. From there, it will be possible to determine um, whether the company profits after tax come from core activity or from other activity. If if profit come mainly from main uh, activity, this is a good thing because today, strongly developing business focus on only one main product. Strong products from which it is easy to build, dominate, and plan the market.
Hello everyone, I'm Hongwei and in today's presentation I would like to introduce about the cash flow statement. Money is likened to the blue surface of business. Without money, the operation of the business will be difficult. It cannot find funding, the business will go bankrupt. Therefore, business managers, including investors and sponsors, are very interested in the cash flow situation of the business. And the cash flow statement is a financial statement that summarizes movements of a cash and cash equivalent. Stocks come in and go out of the company in the period. An example of a cash flow statement. From the above example, we can see that the cash flow statement is split into three sections. The first section will have the work operating, the second investing, and the third financing. And first, operating cash flow. The cash flow relates to the main revenues producing activity of the enterprise. Example, cash receipts from the sale of goods or delivering a service, and income taxpayer, and cash payment to and on behalf of employee. Second, investing activity. They show the extent of the new investment in assets, which will generate future profits and cash flow. Example, cash payment to acquire PPE, intangible shares or loan of other entity. And third, financing activity. Financing activity, this section shows the share of cash with the entity capital providers have claimed during this period. Example, cash proceeds from issuing shares, loans, bonds, or cash repayment of small part on this liability. To know more about what's uh, inside the company to get a more meaningful look, we had to go deeper into the cash flow. Let's walk through an example of a cash flow statement. Look at what each section is showing. Operating activity. In this section, we can see incoming cash value recorded in positive, while outgoing cash value are negative and are usually reversed in brackets. When you subtract the outgoing value from the incoming value, you arrive at the net cash flow for operating activity. In the example, we can see that the net value for operating activity is positive, which is a good sign for investors. Second, investing activity. Since the core operating activity are generating income, the business can now invest in equipment. Because the company is investing $500,000 in equipment, its cash flow in this section is negative. This negative is not value a bad thing. You can say that the company capacity to investing in PPE reflects its growth. And Financing activity. After eating engagement, the company still has 10,000 to pay up its debt. In this case, no payable. Besides this, the company will still have plenty to cover its loan in future. And when you add on three next value from this three session on the cash flow statement, you write as net cash flow value. We see indicate 2,528. This shows that the company has enough cash to continue operating. Hope my presentation will be useful to you. Has been that helping you better understand the cash flow statement. Thank you for listening.